You're welcome once again this evening to our financial reporting class. Guess we would have to start. It's already 5 after when we are supposed to commence so that we can finish early and go and rest early enough. So tonight, what we want to do is to solve questions on leases so that we know that we're putting leases behind us. And as soon as we're done with that, then we'd be moving on to more important topics on Saturday. So please confirm first that you can hear me before I proceed with the class.
Good evening, sir. I can hear you.
Okay, Joseph, good. Okay, so you're welcome again. We started leases yesterday, and I told you that lease is a contract or part of a contract that conveys the right to use an asset to another party for a period of time in exchange for a consideration. And majorly, leases is what we popularly call rent or hire purchase. So IFRS 16 looks at how we account for that process. We looked at the parties to a lease contract. We said that we have the lessee and we also have the lessor. The lessee is the tenant, while the lessor is the landlord. And how do you identify that there is a lease in a contract? What we look at is right to control. And when we say right to control, we mean that the lessee, who is not the owner of the assets, has the right to control the assets. That clearly would indicate that there is a lease in a contract. And when we say right to control, it means two things. It means that the lessee has the right to obtain substantially all the economic benefits in the asset. And also, he also has the right to direct the use of the assets. We looked at some questions to learn about right to control, and we solved it. And we also identify that when we say lease term, we are talking about the non-cancelable period over which the lessee has right to use the asset. And this lease term can be extended. And this period of extension would be considered as part of the lease term if it is reasonably certain that the lessee will extend. And this is especially the case where where it is favorable for the lessee to extend. And where we are sure that the lessee will not terminate, even when there is a period of termination included in the contract, that means we will not just consider it when determining the lease term. The lessee, in accounting for leases, now puts the assets in his books, as well as the entire lease rentals that is going to pay over the lease term. He also recognizes that at the inception of the lease. The lease liability, he measures it initially at the present value of the unpaid lease rentals, and at the end of the year, you would add interest to account for time value of money, and you will also decrease rent that is pays every year. And this is applicable in this order where the lease rental is paid in arrears. If the lease rental is paid in advance, we would then have to decrease the lease rentals before you add the interest. And for the right of use assets, which is the asset that is acquired in the lease transaction, he would measure it at cost. And for him, the cost is the total amount of rent he will pay over the lease period, which is segmented into how much he is owing at that date, which is the amount at which we valued or measured the lease liability, and how much he has paid at the commencement date, which is in case he has paid any deposit. Then we add any initial direct cost and also the commissioning cost. At the end of the year, he uses either a cost model or a evaluation model to depreciate the leased asset or the right of use asset. There are optional exemptions available whereby you won't have to apply the above accounting method. That all you have to do is just to recognize the rent you're paying on a straight line on to P&L. I mean, not on a straight line, to P&L every year. So, and those optional exemption applies to scenarios where the lease is a short-term lease, usually less than 1 year, and also the asset is of low value. For the lessor, who is the owner of the asset, he needs to identify the class of lease he has entered into first, which can either be a finance lease or an operating lease. A finance lease is a lease where the lessor transfers the substantial risk and reward attributable to that asset. Operating lease, it doesn't transfer such risk and reward. And what show that we have a finance lease in our hands will be where the contract states that there will be transfer of ownership at the end of the lease term, and where there is a purchase option, which is the amount that the lessee is expected to pay at the end of the lease term to get ownership. And this purchase option will be so small that if you compare it to similar asset value at that exercise date, you see that the amount is required to pay is chicken change is so insignificant. And also the lease term is substantially equal to the useful life of the assets. The lease liability or the PV of lease rental is also substantially equals the fair value of the asset, and the asset is a specialized asset. So when you have a finance lease, then what the lessor have to do is to derecognize that asset from his books, since it would eventually transfer ownership. So remove the asset from your books, then recognize the rent you're expecting, which you call net investment in the lease or lease receivable. And this is calculated by looking at the present value of the unpaid lease rentals and the present value of unguaranteed residual value. This totals what is expecting over the lease term. At the end of the year, again, it will increase that lease receivable with interest and decrease the lease receivable with rent. Again, this is also applicable where the lease rentals are paid in arrears. If the lease rental is paid in advance, then you will reverse this order where you will decrease the lease rental with rent before you add the interest to the lease receivable. I mean, yeah. So we will reverse this order. Finally, is where the lessor is a manufacturer or a dealer of that item. We said that it needs to recognize a gross profit in addition to the lease receivable he recognizes in its books. And this is because he's a manufacturer or a dealer. And since that is what you sell, and finance lease is just similar to that you have sold the asset, then make sure you recognize sales and cost of sales, just so that you are not trying to um, use a loophole in reporting. So we say that recognize the sales at the lower of the fair value of the assets and its PV of unpaid lease rental, pick the lower, and the cost of sales is the cost of the asset minus the PV of unguaranteed residual value. And I explained why this is deducted here. I told you it's because it cannot be added up here, because IFRS 15 will not allow such an amount to be added as sales. So in order for it to still have an impact on our gross profits, I said we deduct it from the cost of sales. We ended it with operating lease, where the lessor has entered into an operating lease arrangement. The lease rentals receivable should be recognized to profit or loss on a straight line basis over the lease term. And that was all we did yesterday. Today, we'll solve questions, and that will be it for leases. Now, is Femi in class?
Yes, sir. Good evening, sir.
Hey, Femi, how you doing now?
All right, sir.
Okay, please read this question for us.
Okay. On January 1st, 2022, Networth Limited bought a plant from Password Limited under lease contract. The terms of the lease required Networth to make 4 annual installments of 2 million naira each, payable at 31st December. The present value of the lease payment is 5.7 million naira. The interest rate implicit in the lease is 15% per annum, and it is estimated that the plant will be economically productive for 5 years. There is an opportunity to extend the lease term at condition favorable to net worth. The reporting date of net worth is 31st of December. Required, show the financial statement extract of net worth limited over the relevant period.
Thank you very much. So if you look at this question, the inception of the lease is 1st January 2002, and in this lease arrangement, Network bought a plant from Password under a lease contract, and the term is that there will be 4 annual installment payment of 2 million naira each, and which is payable at the end of each year. This one tells me that being payable at the end of each year means that the rent is paid in arrears. The rent is paid in arrears since it's paid at the end of the year. And this 2 million is going to be paying for 4 annual installments, unless otherwise stated. That means the lease term is 4 years. And of course, net worth is the lessee, Password is the lessor. We're now told that the PV of the lease rentals is 5.7 million. So the examiner already gives me the PV of the rent. Fantastic. Furthermore, I was given the interest rate implicit in the lease, so which is the discount rate. And this is necessary just so that I'll be able to determine the interest that I will usually add to my lease liability. And we're told that it's estimated that the plan will be economically useful for 5 years. Now, that means the useful life of the plant is 5 years. Now, I was told that there's an opportunity to extend the lease on the condition favorable to network. So I'm told now that there is a period of extension that it can extend. Now, and I was told that the condition is favorable to net worth. That clearly shows that net worth will extend the lease. Now, having identified earlier on that the lease term is 4 years because it's a 4 annual installment payment, now that I'm told that it can extend, then I can conveniently assume that the lease term should now be 5 years. Since I'm not told otherwise, that means it can only extend to 5 years. It cannot extend beyond the period that the asset is economically useful or productive. So it has to be limited to the useful life of 5 years, and that would represent my lease term. Now, I'm told that the reporting date is 31st December. Now, I'm asked to do a financial statement. I'm asked to do a financial statement extract. Now, this financial statement extract would be my final solution. I will start with workings. My workings one, I can either do my right of use asset or lease liability. Either one is fine. I usually like to start with lease liability because I will need some of the figures here for right of use asset. So my lease liability, I usually measure it at the present value of unpaid lease rentals. The question already gave me as 5.7 million. Now, since the question gives me 5.7 million, that is how I would measure it. You see, if you were not given by the question, then you will have used annuity formula to get this PV of unpaid lease rentals, which is one minus 1 plus R raised to power minus N over what? Over R. Whatever you get here, you multiply it by the 2 million. That's if you were not given. So in this case now, the R will be the discount rate of 15%. The N will be the 4 annual installments, not these 5 years, because we are paying this 2 million for 4 years. We are paying it for 4 years. So this N is going to be 4 years. So that should give us something close to this. But since they have given us this, then fine. We don't have to bother ourselves with that. Now, this 5.7 represent the value of the lease liability at 1st January 2002. At the end of each year, at the end of each reporting date, then that is when you would have to add the interest and remove the lease rentals from the lease liability. So how do we achieve that? So let's do 2002 first. Let me put my nearest sign here. Now, the balance at the beginning was 5,700,000. I will add my interest, let me call it finance costs, at which rate? 15%. At 15%. So what's 15%? Can you please make out your calculator? What's 15% of 5.7 million?
$855,000.
855,000.
Okay. 855,000. And I will deduct my lease rentals. How much am I paying as rent? 2 million. So you have to follow this order. Add the finance cost first before you deduct the rent. If the rent is paid at the end of each year, that is in arrears. So we are going to look at a correction where it is paid in advance, and you will see how that is resolved. So what's the balance at the end of the year? What do we have?
4,555,000.
Correct? Okay, so we'll bring forward 4,555,000. What's 15% of 4,555,000?
$683,250.
250.
Then the rent is 2 million. The rent is 2 million. So what's the balance?
3,238,250.
here. 2004, we have 3,238,250. What's the finance cost? 15% of 3,238,250.
485,737 naira 0.5. You can just approximate it.
Yes. Now remove the rents. What's the balance?
One
1,723,988.
1,723,000.
Am I correct?
723,988.
Okay. Million 723,988. So what's 15% of that?
258,598.2.
Remove 2 million. Ordinarily, this should give us 0. If it's not giving you 0, it's an approximation issue. So, but whatever, let's have it. How much?
Giving us minus figure. Minus 17,414.
17.
414.
Okay. So we'll use it for nothing because ordinarily it should be 0. Now we are done with the lease liability. I've done the lease liability over the relevant period as requested by this question. As requested by this question. Now, the second thing I need to do is my right of use assets. And the right of use assets is the same thing as is the present value of unpaid lease rental, just the same way you have measured the liability. And if there is any amount paid at commencement dates, you can then add it, but here we have none of that. So in that case, the cost of my right of use assets is 5.7 million. And at the end of the year, we'll do our depreciation per annum, which is 5.7 million divided by, you need to remember that when you're calculating depreciation under leases, it should be over the lease term, not over the useful life. So some people will say the lower of the lease term and the useful life. But why would the useful life be lower than the lease term? Why would you lease an asset for a period that is higher than its useful life? So one would not expect the lease term will be lower. Mostly will be higher, mostly it will be lower. So it works like this. So the depreciation per annum is ordinarily the lease term should have been 4 years, but because they said it can extend, so it becomes 5 years. So What is the depreciation per annum now?
1,140,000.
1,140,000. Can you still see my screen?
It's angle. We can't see what you are writing.
Okay. 1,140,000. Okay, so I'm done with everything. Now let's prepare my statement of profit or loss for the year ended 2002, 2003, 2004, 2005, 2006. Okay. So what goes to my P&L? First, my finance cost goes to P&L as an expense. So my finance cost in 2002 was 855,000. For 2003, 683,250. For 2004, 485. For 2005, 258. My depreciation is 1,140,000. 1,140,000. 1,140,000. 1,140,000. 1,140,000. In my statement of financial position, as at year ended 2002, 2003, 2004, 2005, 2006, my currency then under my assets, I have my non-current assets, then my right of use assets. The cost of the right of use assets was 5,700, and that will be the cost all through, minus the accumulated depreciation. That's 1,140,000. In year two, it will be 2,280,000. What will it be in year three?
3,420,000.
420,000.
What will it be in year four?
4,560,000.
And in year five, so
5.7.
5.7.
okay, so the carrying amount, so this will be 4,560,000. This will be 3,420,000. This will be 2,280,000. This will be 1,040,000. This will be 0. Okay. Then for my liabilities parts, I will have my non-current liabilities and also my current liabilities. I have lease liabilities here under current. I also have lease liabilities under non-current. So in 2002, my lease liability was 4,555,000. However, since part of this amount will be paid next year, so the portion that is paid next year, that portion should be classified as a current liability, while the balance should be classified as a non-current liability. So this 4.5 million should be splitted. So how much are you paying next year? So the easiest way for you is just to do 4.555 million minus the balance of the liability the next year. Since the liability will reduce from 4.5 million to 3.238 million, that means they will have paid the difference. Can you hear me get that difference? Anybody?
1,316,750.
1,316,750. Is that correct?
Yes, sir.
Said, is that correct?
Yes, sir.
So if that is my current, that means the balance. If you take this amount, this 1,316,750, if you take it away from this, that balance should definitely give you this 3,238,250, and that will represent my non 3,238,250. Let me confirm. Yeah. So of course, if you add this 3,238 plus 1,316, it still gives you this 4,555,000, which is the total lease liability for the year. So we have successfully separated it into current and non-current. So the current portion is the portion that is due next year, which is this 4,555 minus this amount. That difference will represent what we will have paid or what we will pay next year. That's the current. Then, of course, this balance becomes the non-current because that will be payable in more than 1 year. So that's non-current. So we have splitted that. In year 2, our lease liability is 3,238,250. Again, we will need to separate this amount between current and non-current. The current is the portion of it that you are going to pay next year. And the best way to do that is to get the difference between this and the balance of the liability next year, because this balance will represent the reduced liability after payment. So the difference will represent what you will pay next year, which is our current liability this year. So can somebody get me the difference?
1,514,262.
1,514,260.
Can you come again, please?
1,514,262.
Okay. 1,514,262. While this will definitely be the non-current, so let me just copy and put it here. So of course, if I add this non-current and this current together, it's still going to give me this total, the total lease liability, but it's important we separate it into the amount or the portion you are going to pay next year and the portion you are going to pay much later into the future. And like I said, just get the difference between these two to give you what you're paying next year, and the balance becomes what you're paying after more than 1 year. In year 3, our lease liability is this. And since the final payment is the next year, so we would expect that this entire sum will be paid next year. Therefore, this entire amount is current because it's payable next year. So I will put the amount under current liability because we expect that we should settle it out in 2005. Okay, and that's the end of this question. That's the end of this question. Okay, if there are no questions, Femi, can you read the next question, please?
A company enter into a 4-year lease commencing on 1st of January 2001 and intend to use the asset for 4 years. The terms are for payments of 50,000 naira commencing on 1st of January 2001 and annually thereafter. The interest rate implicit is in the lease is 7.5 and the present value of lease payment not paid at 1st of January 2001, i.e. 3 payments of 50,000 naira. Discounted at that rate is 130,026 naira. Legal costs to set up the lease incurred by the company were 402 naira. Required show the lease liability from 1st of January 2001 to 31st December 2004 and explain the treatment of the right of use assets.
Thank you. So when you look at this question, you will see that this company entered into a 4-year lease, which means that this is the lease term and it's commencing on 4th January 2001, which means that this is the commencement date or the inception of the lease, and intends to use the asset for 4 years. So the terms of the payments are 4 payments of 50,000 commencing on 1st January 2001 and annually thereafter, which goes to show that the lease rentals, the rent he will pay is 50,000 and he will start paying right from the commencement date, which means that this lease rental is paid in advance since payments would commence on 4th January 2001 and annually thereafter, meaning at the beginning of every year he pays. We're given the interest rate implicit in the lease to be 7.5%, and we're also given the present value of the lease payments that was unpaid at the beginning of the year, which is 3 payments of 50,000 discounted at that rate to be 130,026. So we're given legal costs of 402. We're now required to show the lease liability and the treatment of right of use assets. So this one didn't ask us to prepare financial statement. So on 4 January 2001, our lease liability the amount we are owing is simply 130,026. That's what we are owing. That's the unpaid lease rentals. And as the question has clearly stated, it's just the remaining 3 payments that we are owing. Since we will have paid, or on this date, on this same date, we will have paid 50,000, the first installment. So the only portion we are owing is the PV of the lease unpaid lease rentals. PV of unpaid lease rentals. And the question has given us as this. Again, if you were not given in this question, you will have used 1 minus 1 plus r raised to power minus n over r. Then you can then multiply that by 50,000. That should give you this present value, where the R will be 7.5%, the N will be 3 years, because that's the period of unpaid or the number of installments remaining. However, at the end of each year, starting from the end of 2001, the balance at the beginning is given to us as 130,026. Now that the rent is paid in advance, that means we'll deduct the lease rentals first. And in this case, we don't have any lease rentals to deduct at the beginning because it has already been paid. It's not part of what we are owing. Okay, it's not part of what we are owing. It has already been paid. So we're still owing this. Then we will need to add finance costs at 7.5%. We need to add finance costs at 7.5%. Can somebody do 7.5% multiplied by 130,026?
1,733,680. 1,733,680.
No. 7.5% of 130,026.
7.5.
9,752 naira approximate.
Yes,
Oh,
that's more like it. So 7.5% should be 0.075 times 130,026. So balance carried forward. What's the balance now? Anybody?
139,778.
139,778. So in 2002, we'll have 139,778. And how much is the lease rentals? 50,000.
50,000.
What's the balance? 89,778.
8.
What's the finance cost?
6,733.
6,733. Can you add it together, please?
96,511.
96,511. In 2003, So we have 46,511. So what's the interest? 1.5% of 46,511.
3,488.
So what do we have as the balance?
49,999.
That is approximately, let's just approximate it. Okay. So this becomes 0. And it ends there. For the right of use assets, you measure it at the PV of unpaid lease rentals, which is 130,026. You would add amounts paid, the commencement date, which is 50,000. Then you add initial direct cost, which in this case is the legal cost of how much? 402. So the cost is 180 428. If you add the three together, and at the end of each year, we are going to determine our depreciation per annum, which is the 180 426 divided by the lease term. So what's the lease term here? 4 years. So how much are we looking at?
45,107.
How much?
45,107.
Okay.
So, sir, the 180 for depreciation per annum is 180,428, not 426.
Oh, okay. Yeah. I would, okay, 48. Yeah. Thank you. Were you in the class in the morning, Michael?
Yes, sir.
Oh, you didn't see anything in the morning.
Yes, I was actually in the church, so I just had to
Oh,
mute
okay.
myself. Yes.
So sorry, we are taking your church time.
No problem,
Okay.
sir. Thank you, sir.
All right. So that's the end of this question. So see, leases for your exam is never going to be more than this. Just so I've shown you a case where the lease rental is paid in advance. So you deduct the lease rental before you add the interest, and a case where the lease rentals is paid in arrears, where you would add the finance cost before you deduct the rent. Okay, so let's go to lessor accounting questions. Let's go to lessor accounting questions. Which one should we do first? Okay, let's solve this question first. Can you please read this question?
A lessor enter into a 3-year leasing arrangement commencing on 1st of January 2003. Under the terms of the lease, the lessee commit to pay $80,000 per annum, commencing on 31st December 2003. The residual guarantee clause required the lessee to pay $40,000 or $40,000 less the asset's residual value if lower. At the end of the lease term, if the lessor is unable to sell the asset for more than $40,000, the lessor expects to sell the asset based on current expectations for $50,000 at the end of the lease. The interest rate implicit in the lease is 9.2%. The present value of lease payment receivable by the lessor discounted at the rate is $232,502. You are then required to show the net investment in the lease from 1st of January 2003 to 31st of December 2005 and explain what happens to the residual value guarantee on 31st of December 2005.
Thank you very much. So the examiner, if you look at the requirement of this question, we're told to show the net investment in the lease from 1st of January 2003 to 31st December 2005 and explain what happens to the residual value guarantee. So if you look at this question, they said the lessor enters into a 3-year leasing arrangement commencing on 1st January 2003. That means the lease term is 3 years and the commencement date is 1st January 2003. And we're told that under the terms of the lease, the lessee commits to pay $80,000 per annum, commencing on 31st December 2003. That means the rent the lessee will pay is $80,000, and this is paid at the end of each year, which shows that this rent is paid in arrears. We're told a residual value guarantee requires the lessee would pay $40,000 less the asset's residual value if lower. So the residual value that the lessee is guaranteeing the lessor is 40,000. So at the end of the lease term, if the lessor is unable to sell the asset for more than 40,000, however, the lessor expects to sell the asset for 50,000. That therefore means that the residual value guarantee is 40, and there is now an unguaranteed residual value of 10,000. So since the lessor believes he can sell it for 50, so out of this 50, the lessee has guaranteed 40. That don't worry, me, I'll give you 40. So the remaining 10 is unguaranteed. Unguaranteed. Now, we're given the interest rate implicit in the lease to be 9.2%. And we're also given the present value of the lease payment receivable by the lessor at 232,502. So, what's the net investments in the lease? Yeah. Okay. So my net investment in the lease, first, on 1st January 2003, which is the inception of the lease, I'll determine the PV of unpaid lease rentals, which the question gave us as how much? 232,502. That's the last item in this question before the requirement. That's the PV of lease rentals receivable by the lessor. So they will always give you that in the exam, 232502. Then you would add the PV of unguaranteed residual value, which is 1 plus R raised to power minus N multiplied by the unguaranteed amount of 10,000. Then 1 plus R is similar to 1 point, this is 9.2%. That'll be 1.092 raised to power minus N. What is the lease term? That's 3 years. So what do we have? 1.092 raised to power minus 3 multiplied by 10,000. What does that give us?
7679.
7679. 7679. Okay. So what's the total?
$240,181.
240,181. Now, the question wants us to do the net investment in the lease from 2003 to 2005. Okay, so let's do that for them. So the balance brought forward is 240,181. Since the payment is made in arrears, I will add my finance income at 9.2%. So how much does that give me? How much does that?
22,097 approximate.
Okay, 32.
22. 22, sir. 22.
Okay, 22. Then we'll deduct the lease rent house. How much is the lease rent house per annum? 80,000. 80,000. So deduction. Okay. So what's the balance?
182,278.
182,278. Okay. In 2004, we have 182,278. What's 9.2% of 182,278?
10,770.
10,000.
16,770.
Okay, 16,770. Then I deduct my lease rentals. So what's the balance?
119,048.
19,7. Is this okay? 748. Now in 2005, which is the final year, 19748. So what's 9.2% of that?
10,952.
10,000. Sure.
Sorry, excuse me, sir.
Yes.
The balancing figure, carry forward for 2024, I think is 119,048.
Okay. 048. Okay. So what do we have as balance now? Anybody?
50,000.
50,000, sir.
So I've done that. So the question is asking us to explain what happens to the residual value guarantee. Okay. Let's see what happens to it. Now, see, this 50,000 is the residual value. Is the residual value of the leased assets. The lessee has guaranteed 40,000 of this amount, which means that if the lessor is unable to sell the assets, the lessee will give him 40,000. However, if he is able to sell the asset, he is able to sell the assets for 50,000, then the lessee will not bother giving him any sum. So if he's able to sell, so that's the whole idea of this residual value, whatever is remaining. Out of this amount, he has been guaranteed 40K, 40,000. So, but if he's able to sell the asset for this amount, this 50,000, then the lessee will not bother giving him anything. But if he's able to sell it for, let's say, 20,000, that means the lessee will have to make up with 20. So that because the minimum guarantee is 40, at least he will get 40. At least at the bare minimum, he has to get 40. Okay. Let's look at this question. Let's be fast. Our time is fast spent. Before you know it, it's over. Please read this question. Let's see if we can nail anything here too.
Able Leasing Co. Financing arrangements for its customers for bespoke equipment acquired from manufacturers. Able Leasing lease an item of equipment to a customer commencing on 1st of January 2005. The expected economic life of the asset is 8 years. The term of the lease were 8 annual payments of $4 million, commencing on the 31st December 2005. The lease guaranteed that the residual value of the asset at the end of the lease will be $2 million, although Able Leasing expects to be able to sell it for its part for $3 million. The present value of the lease payment includes the residual value guarantee discounted at the interest rate implicit in the lease of 6.2%, was $25.9 million. This was equivalent to the purchase price. You are then required to discuss the accounting treatment of the above lease in the financial statement of Able Leasing Co. for the year ended 31st December 2005, including relevant calculation. Work to the
Okay.
nearest 0.1 million.
Okay, meaning make your this 0.1 million means that the way they wrote this 25.9, so your answer should be in one decimal place, something like that. I'm not going to solve this. It's the same thing as the previous one. There's nothing different here. So it's just the same thing as that other one. So solve this as assignment for do this as assignment. So let's go to the remaining questions. Please read this question first.
A manufacturer lessor leases out equipment under 10 years finance lease. The equipment costs 32 million naira to manufacture. The normal selling price of the leased asset is 42 million naira, and the present value of the lease payment is 38 naira. The present value of unguaranteed residual value at the end of the lease is 2.2 million naira.
Okay, so they didn't give us any requirements here. So let's see what they want us to do. Sorry. Yeah, I'm back. Okay, so looking at this question, we're told that a manufacturer lessor leases out 10 years, leases out equipment under 10 years lease. The cost is 32 million. The selling price is 42 million. The PV of lease rental is 38 million, I guess. The PV of unguaranteed residual value is 2.2 million. So, required account for this lease in books, the lessor. Now, since this lessor is a manufacturer lessor, it means that in addition to net investment in the lease, it must also determine gross profits. So let's determine the net investment in the lease, which is the present value of unpaid lease rentals. How much is that? That's 38 million. 38 million. And we will add present value of unguaranteed residual value. What's the present value of unguaranteed residual value? That's 2.2 million. 2.2 million. So we'll have a total of 40.2 million. We'll have a total of 40.2 million. So they didn't give us any discount rate, so we cannot do interest and all of that. And they didn't even give us the lease rental. So we'll just stop here for that. This is the net investment in the lease. Then we would also do determination of gross profits, which will just do our sales minus my cost of sales. So my sales is the lower. My sales is the lower of the fair value of the assets, which is the selling price of these assets, which is fair value of the assets, which in this case is 42 million. And the PV of lease rentals, which is 38 million. PV of lease rentals, which is 38 million. So in this case, the lower is the 38 million. The cost of sales is the cost of the assets. What is the cost of the assets? That's 32 million. 32 million minus PV of unguaranteed residual value, which is 2.2 million. So can you do 32 minus 2.2? That should be 29.8. Can you confirm, please?
Yes, sir.
Yes, sir, it's correct.
Okay, so my gross profits. So what's the figure for my gross profits? 38 minus 29.8.
8.2.
8.2.
You said 9.2?
8.2.
8.2.
8.2. Okay, so that's that for this. When it comes to manufacturer or dealer list, so this is just the additional thing you are required to do in the exam. Okay. So can somebody read the final one? Operating leases.
A lessor leases a property to a lessee under an operating lease for 5 years at an annual rate of 100,000 naira. However, the contract states that the first 6 months are rent-free.
Okay. So the requirement here is to account for the transaction in the books of the lessor. So in this case now, this transaction for operating lease, the lease rentals receivable should be recognized to profit or loss on a straight line basis. So we recognize it to profit or loss on a straight line basis. So
That is funny, man.
how do we recognize this to profit or loss on a straight line basis? So how much is the lease term is 5 years. It pays rent of 100,000, and the contract says that the first 6 months are rent free. So which means that in year one, the lessee is going to pay only 50,000 instead of 100,000. So in this case now, I will need to get the lease receivable first. Then I can then spread that equally over 5 years. So in year one, this guy is expecting 50,000. And in year 2 to 5, That is that's 400,000 because you will get 100,000 for each year. So over the lease term is expecting 450,000. So this amount to be spread equally over the lease term. Be spread equally over the lease term. So the lease rental recognized to PLL is 450,000 divided by the lease term, which is 5, and that will be 90,000 per annum. However, there's something that is out of range here, because if we are receiving 100,000 per annum and we are recognizing 90,000 in P&L, that means there should be a receivable at the end of every year. So that means in the statement of financial position, we need to recognize something. So the lease receivable schedule will look like this, our accounts. So in year 1 now, let's say the balance brought forward, let's say 0. In year 1, amount of the lease rental in P&L, amount recognized to P&L, we say is 90,000 per annum. So the rent received in year 1 is 50,000. Since we are telling the guy to only pay 50,000, so there's a balance of 40,000 in year 1. So if you are preparing our statement of profit or loss now, in year 1, that means the lease rentals will be 90,000. And in my statement of financial position, under assets, when it's not current assets, I'll have this receivable of 40,000, this balance here, to be 40,000. So in year 2, the balance is 40,000. I recognize the same 90,000 to P&L. I recognize the same 90,000 to P&L. And then I receive 100,000 as rent in year 2. So the balance becomes 40 plus 90 that I've recognized. So making 130. Then I received 100 out of that 130, remaining 30. So again, in year 2, my P&L still be 90,000. My loan receivable, 30,000. In year 3, now is 30. I recognize 90. I receive 100. So means I'll have a balance of 20. So my year 3, P&L 90, receivable in year 4, I have 20, I receive 90, I recognize 90, I receive 100. There will be a balance of 10,000. So in year 4, 90 goes to P&L, but this 10 now, it has to go to current assets since it's due next year. So it has to be recognized as a current assets since it's due next year. And come to non-current, it's due next year. So in year 5, 10, I recognize 90, I receive 100, then this is 0. Okay, so all this is just showing us is that for operating lease, the question will be structured in this manner where they would ensure that equal amounts of payment is not what you will get. They can tell you there is a rent-free period or there is an incentive, something like that. So the first task you need to do is for you to determine the lease receivable. How much am I expecting over the lease term? Whatever the amount is, just spread it equally over the lease term. This gives us 90,000. This gives us 90,000. So when we get the 90,000, we can then spread that. That is what you recognize to P&L. But since what you're recognizing to P&L is different from what you are receiving, that means there will be some receivables, which is what this is all about. So, and those receivables are recognized as assets because it's part of what you're expecting. Okay, and this is the end of this topic called leases, IFRS 16. So I'm giving you only one assignment here, which is this able listening. Try to solve it. There are a lot of other questions that will be available for you to practice. When you are ready, let me know. I'll give you as many questions as you can. Okay, do you have any questions? Okay, so we're going to meet on Saturday. I think we should take group account out of the way. To take us like 2.5 weeks. Like 2.5 weeks, like that is around 5 classes. To take us 5 classes to finish that. So with questions, we're going to solve and all of that. Then when we are done with that, I think we will do ratio then cash flow. I think we'll be done with your syllabus. Then we'll be left with solving past questions unpublished to apply all of these standards in. So, like I told you today, in October, I think we'll be meeting only on Sunday evening in October. We'll be having just one class. And my aim is for you to have a lot of time to yourself to read, to revise. So anytime we meet in the evening, we'll just be solving past questions together, especially published and cash flows. And that's what we'll be using those evening period to do. But I want to finish up everything that needs to be finished in September. Even worst case, if I'm not finishing, maybe I want to just do one topic or thereabout. That will be left. Nothing serious. So, if you don't have any questions, have a wonderful evening. Bye.
Thank you.
You're welcome.